Hello everyone, this is Andrew McNair from SWAN Capital with our educational economic update for March 2018. In this month's video, I'll discuss some of the major headlines that influence markets in February. I'll also provide you some insight into what these developments could mean for you as an investor. Now, as always, please stay tuned at the end for a required disclosure statement. So domestic markets started 2018 with their best monthly performance since at least 2016, only to stumble in February. Both the S&P 500 and the Dow had their first monthly losses in 10 months, breaking their longest winning streaks since 1959. Overall, the S&P 500 lost nearly 4%, the Dow 4.3%. These losses came as volatility picked up throughout the month. See, in early February, we experienced back-to-back stock sell-offs, followed by large jumps. During 1 week alone, the Dow lost 1,000 points and gained back 300 twice. But this volatility wasn't the result of some negative economic data or geopolitical problems. Instead, it was a combination of emotional investing and computer-generated trading, which is probably to blame. Now, investors became concerned about inflation, yet the labor reports indicated that wage growth was picking up. In other economic news, we received a variety of positive and negative reports. The most recent data for housing showed both new and existing home sales drop slightly in January, while housing starts, on the other hand, hit their second highest rate since the recession. We also received the second reading of fourth quarter GDP, gross domestic product. At 2.5%, the growth matched the expectations. Now, ultimately, though, worrying about inflation and the resulting potential for interest rate increases contributed to much of the month's volatility. And by the end of February, comments from new Federal Reserve Chair Jeremy Powell led investors to believe that interest rates may in fact rise faster than anticipated. In testimony to the House of Financial Services Committee, Powell spoke of global strength and stimulative fiscal policy. He also said that inflation may be moving closer to the Fed's target rate. Now, this positive view of the economy could potentially result in 4 interest rate increases in 2018. And on February 27th, the stocks dropped significantly in response to Powell's testimony. The volatility continued the next day as stocks went back and forth before ultimately ending down. In February's volatility feels really unnerving, I'm sure, but we've been blessed with unusual calm in 2017. See, since 1980, the average S&P 500 correction has been approximately 14%. And last year, however, stocks only fluctuated 3%. So when considering last month's fluctuations, remember that the positive economic perspectives were behind much of the movement. Despite the volatility, consumer confidence easily beat expectations and showed that people feel particularly good about the labor market. See, jobless claims supported this perspective as new unemployment filings remained at near historical lows. Now, while moving into March, we'll pay close attention to inflation rates, interest rates, and investor behavior. And we're already seeing as March unpacks itself more and more volatility. So as developments arise, we'll keep you informed. That's it for this month's educational, informational, economic update. Once again, this is Andrew McNair from SWAN Capital, signing off for the month of March 2018.